Greetings, my beloved clients and friends. Hey, I've gotten a question from 3 clients recently, and my thought was, well, if 3 clients have that question, maybe some more do. So I want to address that question, because the answer is kind of long, and I kind of gave my clients the short version of the answer. But anyways, the question was, should I pay off my 2.75% mortgage? Okay, and my answer was no. And I guess maybe that thought came to their mind because they're like, well, shoot, my money's kind of going down right now. Maybe I should, instead of watching it go down, pay off my mortgage, right? So let me tell you why my answer was no. And the answer revolves around an understanding of inflation. So we have not had a lot of inflation for about 40 years, about 35. And that's because the Fed has been very aggressive. That's been their priority, to keep inflation around 2%. And they've been very successful at it. As a matter of fact, about a year ago, Powell said, you know what, inflation is actually under 2%, and I'm trying to get it up a little bit higher. So he said, I want inflation to average about 2%. And to do that, we're going to have to go a little bit above 2 to get the average inflation rate over time, about 2%. Well, he overshot a little bit. He went a little crazy printing money, and now we're in a situation where inflation has finally showed up in a big way, right? It's around 6%, which is a number we haven't seen in 40 years. And in November, he decided, hey, we went too far. We're going to have to tighten up. This inflation that we're looking at is not transitory. It looks permanent, and we're going to take steps to bring it back down. By that, he means not printing so much money, pulling some money out of the economy, and raising interest rates. Okay, and the market obviously wasn't crazy about that, especially the growth companies. But the point is, inflation is here now. Okay, so a lot of people have never seen it or don't remember it. And so what is inflation? Here's what inflation really is. It's the devaluation of the currency, right? And we look around and we see that the prices of stuff have gone up. But it's not that the price of stuff has gone up, it's that the value of the dollar is going down. Because if you look 40 years ago, a gallon of gas was about $1.50. Now it's about $4.50. So it's a 3x. It's gone up about 3x over that 40-year period of time. Minimum wage in California was $3.35. Now it's $10. So minimum wage has gone up 3x over that period of time. The average house was about $150,000. Now it's about $450,000. So a house has gone up 3x. A typical new car was about $10,000. Now it's about $30,000. So has everything gone up 3%? No. Everything else has stayed about the same. The dollar has gone down by 3x. Okay? And it makes it look like everything's going up. It's the dollar that has been devalued. Why has the dollar been devalued? Because they've been printing more of it. And especially recently, they've been printing. When they print more of it, they deflate the value of it. Okay? So it's not that stuff is going up, it's that the dollar is going down. And I don't know, I told my daughter that I wanted to go to Thailand or Vietnam. I don't remember which one it was. I mentioned it, and for Christmas she gave me a $20,000 bill, but it wasn't dollars, it was in that country's currency. And I'm like, wow. And you know how much that was worth? About $1. So why are people walking around with 20,000, I use the word dollar, but it's not dollars, whatever the thing is, baht, 20,000 baht piece of currency? Because their country has experienced devaluation. Now that's going to happen here too, right? We go to the ATM, we pull out 20s, don't be surprised if before long we go to the ATM, we pull out hundreds. Not because we're way richer, it's just because the value of that currency has gone down. We're gonna be walking around with hundreds. Okay, so that's what inflation is. Now, by the way, everything else stayed the same. The dollar went down. What about the stock market? Well, around that same period of time, the Dow was around 3,000, now it's around 30,000. So the stock market has actually 10x'd in a time when everything else 3x'd and the dollar went down. So why do other things keep up with inflation, but the stock market advances above inflation? Well, two reasons. Number one, why does it keep up with inflation? Because when you buy a stock, you're buying a company, and that company sells stuff. All right, like if you buy McDonald's sells hamburgers, and maybe 40 years ago those hamburgers were $1.50, and now that hamburger is $4.50, right? So if they sell the same million hamburgers, their sales went up 3x because they were able to keep the prices steady with inflation, right? But that's not the only thing that McDonald's has done over the last 40 years. What else have they done? Opened more McDonald's, right? I don't know what the number is, but maybe 40 years ago they had 10 million McDonald's around the world. Now they have 30 million McDonald's around the world. So not only have they kept up with inflation, but they've grown with inflation. And so the S&P 500, for example, it's a pretty good long-term investment, and it'll go above inflation. And when people say the market, oftentimes that's just shorthand for the S&P 500. But the S&P 500 isn't every company. It's only the 500 biggest companies in America that are profitable. Okay, it's the 500 biggest companies in America that are profitable. And every year, on average, they change about 25 names in the S&P. Some years 20, some years more or less, but on average about 25 names a year. And so what's their criteria? If a company's not keeping up with the rest of them, they'll get rid of it. And if a new rising star comes in, they'll add it, right? Tesla just got added about a little over a year ago. So the companies, the 500 companies from 40 years ago are not the same ones today. Most of them have changed, because if they're changing out 25 a year over 20 years on average, they're getting rid of all of them, right? The few that have stuck around are the few that have been able to keep up with the overall growth of those top 500. They're the ones that have been able to stay in the top 500. So it's a pretty well managed portfolio of you're owning a current snapshot of the 500 best companies in America, and they're changing it, right? So yeah, it's kept up with inflation, and yeah, it's outpaced inflation. So it's a good investment long term, and you're looking at, well, shoot, they're talking about inflation, the market's really taking a hit. In the short term, sure, that's true, but over time, we could look at this as the market just went 25% on sale, and probably a pretty good time to buy more. But I don't want to stray too far away from my question, was should I pay off this 2.75 mortgage? My answer is no, because that's really cheap money. And if the money's going down, you're going to pay that back with discounted dollars. Okay? And rates have been low for a while, and a couple of clients that asked were younger. I don't think they appreciate that a 2.75% mortgage is absolutely unheard of by historic standards. Okay? If you could borrow money at 2.75, man, borrow all that you can, because we're never going to see those kind of rates again. As a matter of fact, when Fed Chair Powell announced that he was going to start raising rates, he hasn't even started yet. I think they're scheduled to do the first one in March. So he hasn't even started yet, but the market reacted. Rates are way up, especially mortgages. Those 2.75% mortgages that we get 6 months ago, they're gone. Rates went up into the threes, and now they're around 4. Okay, that's just with the threat, if you will, or the expectation of rates going up. Rates went up over 1%. So imagine when he actually does start raising rates, and they're talking about 3 or 4 rate hikes this year, whether it's 25 basis points or 50 basis points, meaning 0.25% or 1% or 0.5%. So it's possible that he could raise rates by a percentage point or more in the next year or so. Okay, so that 4% mortgage, I would not be at all surprised if mortgages were 5% within a year. Not at all surprised. Okay, and historically that's still pretty cheap. I mean, if you look back over the last 100 years, mortgage rates, normal, average, typical was 6%. I'll tell you an old banker joke. It talks about these old school bankers that operate by the 363 principle. And the 363 principle of banking is this: you borrow at 3%, you lend at 6%, and you're on the golf course by 3. Okay, that's how old school banking used to work. And what that means is they paid 3% for the money, and that means they paid 3% on savings accounts or CDs. They lent it out at 6%. That means they were doing mortgages at 6%, and then they'd be on the golf course by 3. So 6 is a very typical mortgage rate historically. 2.75 is insanely good. 3 is even good. 4 is even good. 5 is even below average. Okay. So, and I'll say this. People might say, well, shoot, I can't get that 2.75 or even the 3 anymore. Should I not? Is that bad for real estate? And actually, if you are borrowing at 2.75 when inflation was under 2, let's say it's 1.75, you were having to pay a net after inflation 1% for that money because you were borrowing at 2.75. It was depreciating at 1.75, so your net cost is 1. But think about this: if now you're borrowing at 4 and inflation is at 6, you're still 2% net positive. You're borrowing at below the rate of inflation. That's a great situation to be in, because basically that's free money. Basically that money is earning you 2%. Okay, so if you hear this and you're thinking, well, shoot, I missed my window to buy real estate. Not really, because real estate is an asset that's going to keep up with inflation. Cash is not. And really the moral of the story is have your wealth in assets and not in cash, because the assets will keep up, the cash will depreciate. If you had $150,000 in your bank account 40 years ago, that could have bought you a house. Today, that only buys you a 30% down payment on a house. Okay, so you're better off just having the house. Okay, so if you're listening to this, you're like, wow, I really shouldn't be holding cash. I should really be holding assets, whether we're talking about real estate or gold or stocks, because they're going to keep up or maybe do even better than inflation, and cash will not. So an enterprising person might say, well, should I short cash if cash is going down? Yes. How do you short cash? You borrow it, right? You borrow the cash and pay it back later when it's gone down. Okay? So let me tell you a story that I've heard many times throughout my career. I've always worked with clients that were, well, not anymore, now I'm older, but when I was younger, I worked with clients that were much older than me, and I'd listen to their stories and I'd learn from them. And I heard this story many times. When we bought our first house, right, the payment was $150. And we were like, how are we gonna pay this $150? Because at that time my husband was only making $5,000 a year. And it wasn't that he was a ditch digger or something. This is a guy that went to college and he had a white collar job, but that's what it was paying back in the day, right? And they're like, how are we gonna make this? But we did it. We did it by faith, and we bought the house. And that $15,000 house, and now it's worth $300,000 or $500 or whatever it's worth. It's the same house, right? They didn't add on to it or anything. They're living in that same little house. It's not that the house got bigger, it's that the cash went down. Okay, the cash depreciated, and some of them, when I was talking, they still had that mortgage, and they're like, yeah, my mortgage payment is $235 a month or whatever. And I'm thinking, that's my car payment, because this was when I was younger too, right? And you're gonna be able to tell that story. We haven't really seen that inflation in a long time, but in 10 years from now, I want you to imagine sitting around with your friends and saying, oh yeah, my mortgage is 2.75, and people are like, what? I just bought a house and my mortgage is 6 or 7. You're gonna sound like a genius, the envy of all your friends, and you're gonna say, yeah, and my payment is $1,500 a month or whatever. And they're like, what? My payment is $6,000 a month. And it's not that they live in a mansion, they're your neighbor. They live in the same house next to you, but because of inflation, it's all gone up. Okay? So, by the way, that number that we said that everything 3x'd over 40 years, if you work that out, it's a 2.78% annual rate. And that's about what inflation's been for the last 40 years. That's because in the first 10 years of that it was higher, and the last 30 has been lower, but that's the average. Okay, so now if we're looking at 4, 5, 6% inflation, we're going to get really good appreciation on assets, gold, houses, stocks, and you don't want to be sitting on cash, and you kind of want to be short cash, meaning borrow from other people, because think about the wages. So 40 years ago, a kid coming out of college was making about $25,000. Now, a kid coming out of college, that same job is probably about $75,000. So think 40 years down the road, that same kid coming out of college with the same job is probably going to be making $225,000. Which might sound like a lot, but it's just that the money goes down. The currency devalues. You do not want to be holding a lot of currency right now. And if you could be short that currency, be short that currency. Okay? And you're going to be really glad that you're 10 years now you paid the minimum on your 2.75 mortgage, and you still have it, because it's going to be like, oh man, that's why I spend on a nice dinner, and that's my mortgage. You know what I mean? Because your wages have gone up and dinners have gone up, but your mortgage has stayed the same because it's a fixed rate. And if you have a variable rate mortgage, that's different, but hopefully nobody has that. If you do, give me a call. But man, if you have a low fixed percent mortgage, look at your house is probably the worst bank. Don't use your house as a bank. It's not a good bank, right? To throw money in, because how are you let's say you put money into the house as far as paying down that debt. You can't get that money out. It's not your money, really. It's the bank's money. And you go to the bank, say, hey, I've been depositing extra into my into my house. I want to pull that money out now. They're gonna be like, here, fill out this application. We'll see if we'll do it for you. And if we do, we're gonna charge you for it. They're gonna charge you to borrow back out your own money, right? And guess what? They're not gonna charge you $275. They're probably gonna charge you $5 or $6. So the house is not a good bank account. Okay, here's the other thing. Your house is going to appreciate because it's your house, not because you have a mortgage on it or not, right? Um, that $600,000 house is going to go up with inflation. If it's paid off, it's also going to go up with inflation if it has a mortgage on it. So it doesn't really help your investment wise. Definitely hold on to that 275 mortgage. That money you were thinking about putting towards that mortgage, put towards another asset. Buy another house would be a smart thing to do, or buy some stocks or mutual funds. Buy the S&P, buy gold, right? Buy an asset that's going to keep up, because we're entering a period when the dollar is devaluating. So you don't want to hold dollars. You'd really rather owe dollars. That's one more thing I wanted to say about that. Is there a situation where my answer would be different? Yes. Okay. If you're saying, okay, I really want to pay down my house. I want to pay it off, so I'm going to put an extra $500 a month to my mortgage, or $1,000 a month to my mortgage. If the alternative is, and if I don't put $1,000 into my mortgage, I'm just going to blow it at Home Goods, right? Because I know me. If it's sitting in my savings account, I'll spend it. If that's why you're putting money into the mortgage, then I'd say, okay, go ahead. Right? If you say, man, if it's sitting in my savings account, I'm just going to buy a bunch of more toys for the kids that they're going to play with once, and then we're going to have to give them away to Goodwill, or I'm just going to go buy the latest fashion trends that are going to be out of style in one season. You know, if the alternative is that you're going to buy something that's going to depreciate even more than cash, then go ahead and pay off your mortgage. And I could understand that. Maybe some people they can't handle money in their savings account or so forth. So if that's your scenario, go ahead and pay off your mortgage. But if you have the discipline to say, I'm either going to pay off my mortgage or buy another house, or I'm going to pay off my mortgage or put it into this investment account, definitely choose the latter. Do not pay off that mortgage. Okay. There's one other situation where I would say, go ahead and pay off that 275 mortgage. Let's say you're working right now and you're making $150,000 a year, and you're going to retire in 5 years. And when you retire, your income's only going to be $60,000 a year. So you kind of want to get rid of that expense, because your income's going to go down and you want your expenses to go down. In that case, yeah, try to get that mortgage paid off before you retire, or about at the time you retire, so that the end of that payment coincides with the end of your high income. Now, for my clients, that's not the case, because we've been planning, and when you retire, your income's going to be comparable to what it is when you were working, because we've been building up an asset base. So if your income in retirement is going to be about the same, there's no rush, right? Only if your income is going to go down substantially, then you want to get rid of that expense. So those are the only two scenarios. If the alternative is you're going to blow it on assets that are going to, I don't even want to call them assets, on stuff that's going to depreciate more than cash, go ahead and do it. If you're expecting a significant drop in income in the future, then go ahead and do it. But otherwise, hold on to that thing, and you're going to brag about it in 10 years. You're going to brag about your little tiny $1,500 mortgage payment when, you know, people are renting at $6,000 a month, and the neighbor's mortgage is, you know, $6,000-$7,000 a month, and you know, kids that coming out of college are making $200,000 a year, and you know, average new car is $90,000, because the money's going down. It's not that stuff is going up. It's that the cash is being devalued. So you don't want to hold cash, you want to hold assets. And if you can, be short cash. Hope that answers the question.